Picture two investors. Person A is glued to financial news, trading options and chasing crypto peaks based on group chat rumors. Person B set up an automatic bank transfer 9 years ago and effectively forgot their investment account existed. Person A is constantly moving money around, trying to time the market perfectly. But all that activity generates friction, tax events, and emotional errors. Today, at 52 years old, Person A is essentially starting over. Person B didn't do anything exciting. They simply made a few highly effective, highly repetitive choices. Today, Person B is worth $1.3 million. The financial industry profits off the illusion that building wealth requires complex strategies and constant attention. They sell secret market hacks because patience and automation don't generate clicks or trading fees. Relying on willpower and chasing the thrill of the new will eventually drain your accounts. The most reliable path to a 7-figure net worth is replacing human discipline with a fully automated, entirely boring machine. Before you can pump money into an investment engine, you have to patch the leaks draining the system. The most catastrophic leak is high-interest debt, specifically credit cards carrying rates of 18 to 25%. This chart shows the brutal math of carrying a balance. If you invest $1,000 and earn a 10% return, you make $100. But if you carry $5,000 on a credit card at 22% interest, you're bleeding $1,100 a year. The debt erodes your wealth faster than the market can build it. The second leak is psychological. This graph shows what economists call lifestyle creep. When people get a raise, they almost invisibly upgrade their apartment, their car, and their wardrobe. Your income climbs, but your spending climbs at the exact same rate, leaving you with zero new wealth. To defeat this, implement the 50-50 rule. Every time your income increases, split the new money in half. 50% upgrades your daily life, and the other 50% automatically funnels into investments. You get richer and more comfortable at the same time. The final leak comes from cultural pressure. We are frequently told buying a house is always the smart financial move. But if you stretch your budget, drain your emergency fund, and buy in a high-cost city where renting is dramatically cheaper, you cripple your cash flow. Renting and investing the difference often yields a higher net worth over a 10-year period. You have to clear the high-interest debt, lock down your lifestyle inflation, and keep your housing costs under control. Attempting to compound wealth while your cash flow bleeds out is mathematically impossible. With the leak sealed, you establish the intake valve. You determine a savings rate between 15 and 25% of your gross income, and you set it to transfer straight into investments on payday. The money moves before you even have a chance to spend it. That automated money needs a destination. The U.S. government provides specific legal shields designed to protect your investments from taxes, incentivizing you to save so you don't rely on the social safety net later in life. This funnel diagram demonstrates the exact priority for your money. First is your employer-sponsored retirement plan, like a 401k, specifically up to the company match. If they match 50 cents on every dollar you contribute, that is an immediate 50% return on your money. Nothing in the financial markets guarantees that kind of yield. Once you capture the match, the overflow gets routed to a Roth IRA, where you invest after-tax money today, but your withdrawals in retirement are entirely tax-free. Finally, if eligible, fill a health savings account. It allows you to deduct contributions, grow the money tax-free, and spend it on medical costs without ever paying the IRS a dime. Maximizing these accounts every year is a massive financial advantage. You are legally keeping hundreds of thousands of dollars over your career that would otherwise be taxed away. So the money is flowing automatically into these tax-advantaged accounts. What does it actually buy? The engine powering this entire system is the broadly diversified index fund, specifically ones that track major benchmarks like the S&P 500. People love to pick individual stocks, but look at this grid representing professional fund managers. The data shows that over a 15-year horizon, 85 to 90% of them fail to beat a simple index fund. If the people with massive research teams and specialized software can't pick winners consistently, our odds are remarkably slim. An index fund simply buys a tiny sliver of the 500 largest publicly traded companies in America. You aren't placing a bet on one CEO or one product launch. You are placing a bet on the long-term upward trajectory of the entire capitalist system. To accelerate this engine, you can inject one final component. You build a single, modest income stream outside of your primary job. This means freelance writing, renting a room, or selling a digital template. If you generate just $500 extra a month and strictly invest all of it into your index funds, you can compress your timeline to $1 million by up to 8 years. It's a massive amount of freedom bought back with a tiny amount of side effort. Let's run the final math. If you earn $55,000 a year, which is roughly the US median income, and you automate 20% of it into index funds starting at age 30, you will reach approximately $1.9 million by age 65. This path does not yield great stories. You won't have a thrilling tale for dinner parties about a brilliant options trade or a crypto coin you perfectly timed. But what you will have 20 or 30 years from now is an investment account with 7 figures in it. It won't be the result of a single stroke of genius. It will be the accumulation of 1,000 unsexy, reliable choices made week after week. Wealth accumulation is a solved mathematical equation. It doesn't require brilliance. It requires patience, consistency, and the willingness to let a thoroughly boring machine do the work for you. And the best day to turn that machine on is today.